Have you ever wondered how ordinary people become wealthy through investing, while others work their entire lives without building real financial freedom? The truth is, investing isn't just for millionaires or financial experts. It's a skill that anyone can learn, even if you're starting with a small amount of money. Today, we're going to break down the basics of investing and the stock market in the simplest way possible. By the end of this video, you'll understand how investing works and why it has helped millions of Americans grow their wealth over time. Let's start with the most important question. What is investing? Investing simply means putting your money to work so it can earn even more money in the future. Instead of letting your cash sit idle, you buy assets that have the potential to increase in value over time. These assets can include stocks, ETFs, index funds, and many other investment options. The goal isn't to get rich overnight. It's to build wealth steadily through patience and smart decisions. Now, let's understand how the stock market actually works. Imagine a company that wants to grow its business. Instead of borrowing all the money from a bank, it sells small ownership pieces of the company to investors. These ownership pieces are called stocks. When you buy a stock, you're becoming a small owner of that company. If the company performs well, its value may increase, and your investment can grow along with it. That's how many successful investors build wealth over the long term. But why do stock prices go up and down every day? The answer is simple: supply and demand. When more people want to buy a stock than sell it, the price usually goes up. When more people want to sell than buy, the price often goes down. News, company earnings, economic conditions, and investor confidence can all influence these price movements. Short-term ups and downs are completely normal, and they happen in every market. This brings us to one of the most important lessons every investor must understand: risk and reward. Generally, investments with higher potential returns also carry higher risks. That doesn't mean you should avoid investing. It means you should invest wisely. Successful investors don't gamble. They make informed decisions, stay patient, and focus on long-term growth instead of chasing quick profits. Remember, building wealth is a marathon, not a sprint. The strongest investment strategy is one that stays consistent, disciplined, and focused on the future. Now that you understand the basics of investing, let's talk about one of the smartest strategies used by experienced investors: diversification. You've probably heard the saying, "Don't put all your eggs in one basket." The same rule applies to investing. If you invest all your money in just one company, and that company struggles, your entire investment could lose value. But by spreading your money across different companies, industries, or investment funds, you reduce your overall risk. Even if one investment performs poorly, others may continue to grow, helping protect your portfolio over time. Another powerful lesson is understanding the difference between investing and trading. Many beginners believe they can become rich by buying and selling stocks every day. In reality, most successful investors build wealth by thinking long-term. Markets naturally move up and down, but history has shown that patient investors who stay invested for years often outperform those who constantly chase quick profits. Time in the market is usually more important than trying to perfectly time the market. This is where the magic of compound growth comes in. Compounding happens when your investment earns returns, and then those returns begin earning returns of their own. Imagine planting a tiny seed. At first, it doesn't look impressive, but with time, water, and patience, it grows into a strong tree. Investing works the same way. The earlier you start, and the longer you stay invested, the more powerful compounding becomes. It's one of the biggest reasons why long-term investors build significant wealth. That's also why starting early is so important. You don't need thousands of dollars to begin investing. Even small, consistent investments can grow into something meaningful over time. Every year you wait is a year your money loses the opportunity to compound. Starting with a small amount today is far better than waiting for the perfect moment that may never come. Finally, let's look at a strategy that helps reduce stress and removes emotion from investing: dollar cost averaging. Instead of investing one large amount at once, you invest a fixed amount regularly, every week or every month, regardless of whether the market is up or down. When prices are lower, your money buys more shares. When prices are higher, it buys fewer shares. Over time, this simple strategy helps smooth out market volatility and encourages consistent investing. Remember, successful investing isn't about making one perfect decision. It's about making smart decisions consistently for many years. As you continue your investing journey, you will often hear two important terms: bull market and bear market. A bull market is when stock prices are generally rising and investors feel optimistic about the future. A bear market is the opposite. Prices fall, uncertainty increases, and many people become fearful. The important thing to remember is that neither market lasts forever. Every bull market eventually experiences corrections, and every bear market has historically been followed by recovery. Smart investors understand that market cycles are normal and stay focused on their long-term goals instead of reacting to short-term headlines. Unfortunately, many beginners make the same costly mistakes. They invest based on emotions, follow social media hype, panic when prices fall, or expect to become rich overnight. Some put all of their money into a single stock without doing any research. Others keep buying and selling because they think they can predict every market move. These habits often lead to unnecessary losses. Successful investors rely on knowledge, patience, and a well-planned strategy rather than fear or excitement. A great way to begin is by building a simple and balanced portfolio. Instead of depending on just one investment, spread your money across different types of assets. Many beginners choose a combination of stocks, ETFs, index funds, and a small cash reserve. This balanced approach helps reduce risk while giving your investments the opportunity to grow steadily over time. You don't need a complicated strategy to become a successful investor. Consistency is far more important than complexity. Another lesson that separates successful investors from everyone else is learning to control emotions. The stock market will always have good days and bad days. If you let fear control your decisions during market drops, or let excitement push you into risky investments, you may hurt your long-term results. The best investors stay calm, follow their plan, and remember why they started investing in the first place. Emotional discipline is one of the most valuable investing skills you can develop. By now, you've learned the core principles of smart investing. Understand how the market works, diversify your investments, think long-term, take advantage of compound growth, invest consistently, and never let emotions control your decisions. You don't need to be wealthy to start investing. You simply need the willingness to begin. Every successful investor once took that very first step. The sooner you start learning and investing wisely, the greater your chances of building lasting financial freedom for the future. Building a successful investment portfolio doesn't end after buying your first stocks or funds. It's important to review your portfolio regularly and make sure it still matches your financial goals. As your life changes, your investment strategy may also need small adjustments. This doesn't mean checking your portfolio every hour or reacting to every market headline. Instead, successful investors review their investments periodically, making thoughtful decisions based on long-term goals rather than short-term emotions. A simple annual or quarterly review is often enough to keep your portfolio on the right path, Another powerful habit is reinvesting your profits. If your investments generate dividends or capital gains, consider putting that money back into your portfolio instead of spending it immediately. Reinvesting allows your returns to generate even more returns in the future. This creates a powerful cycle of compound growth, where your money continues working harder year after year. Many of the world's most successful investors have built their wealth not by constantly adding huge amounts of money, but by consistently reinvesting the profits their investments earned over time.